I'll give you a call. We'll set up rates.
The seller has to come down in price to the appraised value, or the buyer has to bring some more cash in.
Actually, what he did was he took about 50 different on-campus interviews.
So
I knew that name was.
probably USAC. Everybody's USAC at some point.
So, if you own real estate personally, your personal residence, and Tom alluded to this, it's still available to be written off mortgage interest and property taxes. They haven't taken that away. There's always talk about going to flat tax and not having deductions available. They haven't done it yet, but what they did do this year is reduce your itemized deductions amount if you're over a certain amount of income. So if you make over $400,000, you might lose some of that benefit of your mortgage interest. So just kind of be aware that your taxes might be going up this year. You must have ownership in the house for mortgage interest to be deductible. So I have clients who come in and, I'm paying the mortgage for my boyfriend's house, so I want to take the deduction. He doesn't need the deduction, so I'm going to take the deduction. I really pay the mortgage interest. Well, you cannot take the deduction for mortgage interest if you don't have any sort of ownership in the home. I have a client who was having some financial issues, and we sat down to go over his budget and talk about his spending, and we decided he was spending too much on his mortgage. He was living in a high-rise in Century City, and between the homeowners association and the mortgage, it was just too costly for him to live there. So he decided after he left the meeting, without telling me, that he was going to rent out the home, the condo, and rent something smaller that was less expensive for he and his wife. So that's good news, right? Cash flow wise, he said he's covering his mortgage and his property taxes with the amount of rent he's collecting, and he was paying about $1,000 less per month in rent. So that was really good news in his mind. And the bad news was he forgot to mention it to me when we did his tax planning for the year. So on the good news side, again, the property taxes, mortgage interest still deductible when you convert your residence to a rental. Also, good news, utilities, homeowners association, repairs, any and all expenses related to that property are also deductible. He even can depreciate the house now, write off a portion of the cost of the house every year. The bad news is the rental income. He wasn't thinking about the rental income coming into play in his taxable income. So it basically wiped out all of his deductions because he was covering his costs, remember? So he ended up paying more tax than he did in the previous year. And he didn't count on that, and he didn't call me. So that was his big oops. So, that's just kind of one of the things we try to talk with our clients about. Like, before you make pull the trigger and do something different, talk to your accountant and see if it has any tax implications. So people also want to know if they're going to pay tax when they sell their house on the gain. Those of us who bought in the last, 7 or 8 years, probably not having a gain right now, but if you're my mother-in-law and you bought your house in 1960 for $15,000, and then you sold it in 2008 for $800,000, guess what? You have to pay tax. There is a exception on the sale of a principal residence. If you've lived in your home for the 2 of the last 5 years, you are eligible to exclude some of the gain. It's $250,000 if you're single, and it's $500,000 if you're married. So that's a pretty big amount that they forgive on the gain. That's the thing I usually tell my clients when they sell their house. Well, here's what I paid for it. Well, go back and think about all of the things you did along the way to improve it. Did you put a new roof in? Did you remodel the kitchen? All of that gets added in. So hopefully get that gain below the $500,000 or the $250,000, and you won't pay tax on it. On an investment property, though, you will pay tax. It doesn't matter.
Yeah.
It doesn't matter, how much your gain is. You're going to pay tax. You also can deduct the loss if you have a loss on the sale. The other thing is all these passive activity losses that were maybe not being able to be deducted along the way. When you dispose of the property, those get released, and you can also deduct those in the year of the sale. If you held the property for a year plus 1 day, you get to enjoy the long-term capital gain rates. And the Tax Act of 2013 kept the 15% rate for people under 400,000, and it only went to 20% for people over that. So you'll pay a lower than your normal tax rate, but it's still going to be, between federal and state. If you're in the state of California, it's about 25% of your gain is the tax you'll pay. If it's under a year that you've held the property, you're going to pay at your ordinary rates. So that's, that's just things to be aware of. To say the rules are complicated would be an understatement. So it's important to speak to your accountant early and often. One other question, and Dave alluded to this a little bit, is about forming an LLC versus holding your properties individually. And the LLC means limited liability corporation, so it's really to protect your personal assets from dog bites or someone falling on your property. If you get sued and it's a rental property, and you're holding it in your own name, they have access to all of your other assets. So there are some costs involved with forming an LLC, but the costs probably the benefits outweigh the cost.